Hey everyone, welcome back to Yuri's Box. In this video, I'll be talking about TLT, the S&P PMI reports, and another round of initial jobless claims. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So, in a last-ditch attempt to make this week interesting, Trump has announced that he is seriously thinking about a 50% tariff on Europe. He said it on Friday just to make, the weekend interesting, given the fact that it's also going to be a long weekend. We didn't really accomplish much, on that news. Bonds were basically unchanged, down a basis point on 30s, 2 on 10s. Stocks closed above their, off the lows rather. But again, nothing too dramatic. European stocks were really having a beating today, but again, even they didn't really accomplish much. We're down by 0.5%. So we didn't really accomplish much. But again, this is a TLT video, not a German stock video. So the highlight of the week was really the S&P PMI report. And again, a fresh round of initial jobless claims. Now, if you recall, in the the week ahead videos I made, when talking about what I was expecting on the surveys, for the University of Michigan, I was actually expecting the University of Michigan surveys to come out a little bit more positive than it actually did. But regardless, I was also expecting the PMIs to come out a little bit more positive than they were. And the reason for that is that we went from, the possibility of having a trade embargo against China in April to something that is more manageable. Again, I'll reiterate that something more manageable is still something terrible because it's 30% tariffs, all right? It's a lot higher than where they were before, prior to April 2nd, okay? And even 10% on the rest of the world is still a lot. It's still a big deal. But again, it's just, not the end of the world. It's not decoupling. It's not a trade embargo. So we can breathe a sigh of relief. And for that reason, I was expecting the PMIs as well to be a little bit more positive. And, there's a key passage in the report that, I'll make sure to highlight as it comes along. But that is furthermore down. Just to start off, business activity growth and expectations for future output improved from the lows seen in April, right? Good news. Finally, from April, this is one of the few reports as well, maybe the ISM, that is really just somewhat positive, all right? I mean, it's not positive across the board, but at least it's not, a complete train wreck from top to bottom, all right? However, again, they both remain historically subdued amid ongoing concerns over detrimental impact of tariffs on demand, supply chains, and prices. And again, prices, you continue to see that, the input prices continue to move up, and as it reiterates right here, prices for goods and services surged to an extent not seen since August 2022, overwhelmingly linked to tariffs. Moving on, the headline, PMI composite output rose from 50.6 to 52.1. Rise, signaled an acceleration of activity growth off of, the April low, which was, it's a 19-month low rather. Although it remained one of the weakest readings since early 2024. All right. Manufacturing output returned to growth after falling in both March and April, albeit only slightly. Again, more tariff talk tariffs had in some instances reportedly helped encourage, the domestic side of the market. Exports, not so much. And again, it reiterates again, exports of services fell at the sharpest rate since the pandemic lockdowns of 2020. All right. And moving on to future sentiment. All right. Now, this is the key passage right here. Having slumped sharply to a 2.5-year low in April, sentiment among companies about their output over the coming year rebounded in May to its highest since January. Sentiment went up in part by reduced trade worries following the pause on additional tariffs and accompanying improved economic growth prospects. Again, when you go from I'm going to cut my leg off to I'm not going to cut my leg off, at the very least, that is going to cause a sigh of relief. Your mother, your loved ones are all going to say, thank God you didn't go through with that, man. I'm happy for you. I'm happy for us. We're all happy. But again, I don't really want to fade the entirety of this report because again, it is mostly good news. All right, there is bad news as well, as you'll definitely see later on. But again, it's not a complete train wreck from top to bottom. It's just that, to my eyes, the fact that we have that good in this report, mostly I would say it ties back to this passage right here. We go from the worst case scenario to something that is at the very least manageable. That makes everybody just breathe a sigh of relief. At the very least, we're not going to have a traumatic decoupling. Right? Confidence about the outlook rose to a 4-month high in services and the best in 3 months in manufacturing. Goods producers also continue to display relatively greater optimism, largely based on hopes of greater reshoring of production and demand switching to domestically produced goods in response to tariffs. Again, this is probably the most opium of the passages you'll see here, because again, if there will be tariffs, the good side of tariffs, meaning that we reshore, we bring jobs back to America. I don't think that is going to happen in anytime soon. I think that is still a ways away, and that is a video on itself, really. All right, that is a whole 50-minute video on what will happen if we actually all the consequences. So I'll leave that for another video. Despite the rebound, overall optimism was still slightly below the average seen in 2024, attributable to reports of supply worries, rising prices, ongoing uncertainty, and concerns over detrimental impacts from government policies, including tariffs and spending cuts. I mean, this isn't news if you've been watching, if you've been reading the PMI reports. Reading the PMI reports is definitely not the most entertaining thing you can do with your spare time. But again, if you have been reading these reports, this is hardly news. All right. Now, this is interesting to me. Employment fell slightly in May, having risen in March and April, primarily reflecting concerns over future demand prospects, but also in response to worries over rising costs and labor shortages. Service sector payrolls were trimmed for the second time in 4 months, while manufacturing jobs were cut for a second successive month. I was really expecting this to be a little bit more upbeat, the employment side of things, because last month we had, the April report basically say the exact opposite. It was a train wreck from top to bottom, but the employment part of it was like, employment, rose slightly. It was okay, and it ended up being 177, which, a small caveat to that, watch for revisions. But in this report, we have the exact opposite. We have at least some good news in the lead up, but then the employment is just, cold water. It's like a cold shower, really, because we don't even have, the slightly. It's just employment fell. Again, slightly. It fell slightly, all right, in May. And in services, you continue to see service jobs trimmed. All right, so I'll wait for next week to give my my forecast for the non-farm payroll report. I just do it for fun and games, really, and it's nothing to be taken seriously. But I'll wait for next week to give my forecast on that. Moving on to prices, average prices charged for goods and services jumped higher in May. at a rate not seen since August of 2022. The latest rise in output prices was overwhelmingly linked to tariffs, having directly driven up the cost of imported inputs or caused suppliers to pass through tariff-related cost increases. And again, this continues to go back to this whole, debate of who's going to pay the price, the tariffs. All right, you know what I think. I just think it's going to squeeze margins because again, I don't think the consumers is in any position, or rather, it's not the consumer isn't in the position it was in 2022, where it could absorb price increases. All right, and we just chugged along for a year and a half. But we'll see how things play out. Reading some of the commentary, business confidence has improved in April and in May from the worrying slump seen in April, with gloom about prospects for the year ahead lifting somewhat thanks largely to the pause on higher rate tariffs. Right? It's a sigh of relief. Yes, it's not the worst case scenario. So again, we can just at least it's not the worst case scenario. Again, I reiterate, not the worst case scenario. But it doesn't really change the fundamentals, all right? Again, I go back to the analogy. I want to cut my leg off. I decide not to cut my leg off. It's not like I grew an extra leg, right? I'm still back at square one. And in this case, we're back at square one with 10% tariffs on the rest of the world and 30% tariffs on China. It's hardly good news. We haven't made the situation better in April and in May. That's the bottom line for as far as I'm concerned. And again, here they continue to say, I should have probably highlighted this in green. Current output growth has also picked up in May from April's recent low, which had seen the weakest rise for over 1.5 years in response to an upturn in demand. However, both sentiment and output growth remain relatively subdued, and at least some of the upturn in May can be linked to companies and their customers seeking to front-run further possible tariff-related issues, most notably the potential for future tariff hikes after the 90-day pause lapses in July. Again, is it a complete train wreck from top to bottom? No. The numbers, on the indexes, rose. Good. But we're not really progressing to, we're not really seeing a light at the end of the tunnel. If anything, we're seeing a light at the end of the tunnel, but it's, it's the train, it's a tariff train, and it's coming straight for us. So again, the way I use the PMI report is to come up with my forecast, as I mentioned before. I use what I read in the PMI reports and try to extrapolate, how businesses are, what is the sentiment in the business community to come up with a number. And again, it's just for, fun and games, really. But, I've more or less gotten it close. Last month I gave out, my forecast was for 75K. Now, we did have 177K. And again, I'll come back to the caveat that I said before. Watch for revisions. Right, that is probably one of the most interesting things that I will be paying attention to on, what is that, June 6th, when we have the non-farm pay report, but that is still a way away. So again, just to summarize the PMI report, the employment part of it isn't really constructive. It continues to say, employment falling slightly in May. Service sector payrolls continue to be trimmed. Not great. And most of the constructive narrative that we see and I've read, in this PMI report can largely be traced back to this part right here. The uptick in the sentiment was mainly due to the pause on additional tariffs, all right? And again, right here, gloom about prospects for the year ahead lifting somewhat, thanks largely to the pause on higher rate tariffs. Would I necessarily fade this report in its entirety? No, I don't want to be that harsh. But it's hard to escape the reality of the situation on the ground. We still have 10% tariffs on the rest of the world. We have 30% tariffs on China. And yes, we haven't gone for the nuclear option, meaning decoupling, a trade embargo. And yes, that causes sigh relief in the business environment. I get that. I get that. But the reality on the ground is still bad. All right. So that is my opinion. You're entitled to yours. We'll see how things evolve. The second interesting topic of the week was another round of jobless claims. And again, if you haven't watched my previous videos, the way I'm thinking about initial jobless claims is that we're just going to see a repeat of what we saw last year. All right, pretty boring. Nothing, nothing too exciting, really, in my opinion. Meaning a bottom in January and a lead up to a high in the summertime. That is basically what we continue to see: a bottom in January and a slow grind higher towards the summer. Now, what is curious is if you look at this was the release of the week of May 12th. This year it was 227K. All right. If you go back to 2024, this was right here, 216K. It is a bit of a stretch. I mean, I don't really want to say, I don't want to extrapolate too much of it, is what I'm saying. But still, you get the picture. We're making these kind of higher lows in initial jobless claims. And as I remind everyone every time I make these videos, what makes a recession, the key ingredient isn't so much the loss of jobs. That comes at the end. And if you're waiting for people to lose their jobs to say that the economy is slowing down, that is like saying, I'm not going to shower until I smell like rotten eggs. By the time that happens, everything's already in motion. All right. And what do I mean by that? If you look at 2006 and 2008, by the time, initial jobless claims were, breaking out of, let's say the high that we saw in January of 2005, right here, it was May of 2008. And by the time initial jobless claims peaked in March of 2009, a month later, the recession was over. If you're waiting for initial jobless claims to peak, you're just waiting to be late, in my opinion. All right. But coming back to this week's release, the way I use initial jobless claims is to extrapolate, what will the unemployment rate do in the upcoming non-farm payroll report. All right. And no, I've basically been correct on the unemployment rate 4 out of 4 times. I think I missed one, but regardless, my line in the sand for initial jobless claims is, about 215. Anything below 215, you can expect, the unemployment rate to go lower. That's basically, what has happened during this cycle right here. Anything above 220, 220 is kind of the status quo. If, you see initial jobless claims stay at 220, don't expect many changes in the unemployment rate. However, if you see anything above 220, especially above 225, expect the unemployment rate to move higher in the next report. And what's interesting is that we've had a 241 read at the end of April. We've had 229, 229, 227. For now, the forecast for next week is 230. For the time being, this to me tells me that we're going to see an uptick in the unemployment rate next month. I'll wait for another for next week. I'll just think about it a little bit more. the observation, rather the survey time frame is really between May 9th and May 15th, the 9th and the 15th of the week of the month. So anything, I think this was, this read right here was outside of that. Oh, actually, maybe it was. Regardless, to cut things short, next week's release will likely be outside of the survey period, so that won't likely have an effect on the unemployment rate. Just keep that in mind. But in any case, what we've seen is initial jobless claims move up. So at the very least, that to me tells me that the unemployment rate is likely to move up next month. By how much? I'll wait and see. I'll definitely make a video about that next week, probably in the week ahead, looking for 2 weeks out. At the same time, we got continuing claims. This is another jobless claim, job openings. Here we are. Continuing claims. And again, I continue to say that this looks like, just like a build-up, a crescendo to some kind of a breakout. And again, 2 million doesn't seem totally unreasonable to me. I would not be surprised if by the time it's July or August, we're at 2 million. Again, as I've been saying in my previous videos, 2 million, it looks like an easy target to me at this point. And, if things get, particularly dicey, 2.1 million, is it off the table? Not really. It doesn't seem, again, totally unreasonable as a target. Now, the caveat that I always mention, before when I'm talking about continuing claims, is that we are still, yes, we're off the lows, but again, historically, we are still at subdued levels, all right? For instance, we're still nowhere near the 06-08 cycle lows, all right? Just to tell you the level of, just to show you where continuing claims are. But regardless, the trend is up, all right? And what you don't want to see is an explosive move up. But again, I think that for the summer, 2 million, 2.1, anything between 2 and 2.2 million wouldn't be totally unreasonable, barring, any, huge shocks. All right. If we have anything crazy happening during the summer, don't be surprised if, unemployment starts to move up quite significantly. And that was pretty much it for this week. The highlight of the week was basically Trump, 8 hours ago or so, saying that he wants to put 50% tariffs on the EU. And again, that is just a, if you will, a lower high on the craziness scale. PMIs came out somewhat constructive. It wasn't a train wreck from top to bottom, but the parts that weren't a train wreck mostly were due to the fact that we went from worst case scenario to something that is manageable. All right, meaning a trade embargo to 30% tariffs. And I continue to remind everybody, 30% tariffs is high. It's high. It's nothing to be, to pop the champagne about. So the PMI is not great, not terrible, but the not terrible part, mostly due to the sigh of relief related to the delay in tariffs. Initial jobless claims continue to, move higher. This week's initial jobless claims were a bit of a miss. We were expecting 230, but regardless, we're still above the 225 line. That is basically 220 line in the sand is my personal line in the sand, rather. Which just to me indicates that we're likely to see the unemployment rate move up in the coming non-farm payroll report. Now, coming back to TLT, I want to point a few things out. All right, and I'm gonna say something for the bears, something for the bulls. Try to be as fair as possible. There are a few things that caught my eye. First off, it isn't clean. All right, it's not absolutely clean, but you could paint a picture where we're just putting in the final wave of, and possibly an Elliott wave. Right, so you have your first wave down, retrace, another move down, move back up, and now we're possibly looking at completing the fifth wave. Now, I'm operating as if, we're going to sweep the previous low, all right, and that we actually bottom around, 81.50, somewhere like that. That to me seems, reasonable, given also the context of history, meaning that, TLT likes to sweep the previous low, as it did in 03 and 04, as it did in 06 and 07. Let me see if I can find any other examples right here. 17 and 18, yeah. There are a few exceptions. 2010 and 2011, as I've mentioned before, was a slightly higher low. All right. Now, if we do sweep the previous low, that would just put it in the basket of 06, 08, for example. Now, something for the bulls. Yesterday was interesting to me because the PMI reports were okay. All right. And so okay news for the economy is bad for bonds. But even yesterday, if I'm not mistaken, yesterday was still an up day for bonds, right? So you have at least the vague semblance of a news failure on the PMI reports and bonds. All right, that's something for the bulls. The second thing for the bulls is what we saw today. Again, we saw a small smidge of follow through today on yesterday's price action, and on top of that, you could point to a bullish divergence on the other side. All right. Compared, when you're looking at January 6th and today, this close comes at 37 and, this was 34. So you have price moving lower, but the RSI not cooperating. All right. That to me is interesting. Now, something for the bears. All right. I don't think, again, if you've been following this channel, I'm not bearish medium term on TLT. I actually think that this eventually will reverse. Given everything, I've mentioned in my previous videos. But if I had to point something out short term, I think that history points towards, a sweep of the previous low. I think that this move down here is still not finished, and I think that given usually the fifth wave tends to be a little bit more dramatic than just going slightly lower than the third point. And what else I wanted to point out? And rather than looking at this bullish divergence on the RSI with June 6th and this week, I would keep my eyes on the bigger picture. I would keep looking at the October low on the RSI and potentially a higher read on the RSI with a sweep of this low right here. So you have price going down, say to $81, but you actually have the RSI potentially, let's see if I can actually draw a trend line down here. Say we connect the October 2022 low with October 2023. Look for it to bottom out around 28. That to me would be the biggest story. I wouldn't put too much weight on this divergence right here, what we're seeing between January 6th and May 19th. I would keep my eyes on the big picture. Look at what will happen between this low right here and a potential lower low. All right, that I think would be the juiciest, if you will, bullish divergence to look at. And again, something else for the bears. What else could I point out? I think I'm forgetting something. I wanted to mention something else, but well, probably wasn't that important. So that is pretty much it. As you've seen, I've eliminated the parallel channel. I think it's broken at this point, so no use in keeping it on the chart. So again, PMIs, possible news failure, but it's a bit of a stretch in my opinion. I do still believe that you have some unfinished business, with potential sweep of the previous low, which in my opinion would just be a buying opportunity at that point. But again, we'll see how things evolve. Initial jobless claims, still near the lows. Granted, we're still in the 220s, which is historically low. But we're we're slowly grinding higher, and it'll be interesting to see what happens over the summer. Hopefully, you enjoyed this kind of video. I made it through. Definitely, I've been fighting through a headache, so hopefully it was I did a good enough job. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.